Hello, class. Welcome to this chapter 4 lecture video. Congratulations for making it through your first exam. If you're watching this, you've already went ahead and completed that. I know this is going to be quite overwhelming for you, maybe at this point. Accounting is at this fast of a pace. Normally, you'd spend about 3 weeks going through on a normal time. In a normal term, about 3 weeks going through what you all just went through in about a week and a half, about 9 days. That's the joy of these 5-week summer classes. You don't have to sit through the whole term, but man, once it gets going, it really gets going and you got to stay on top of it. And I appreciate all the hard work that everybody's putting into it. So debits and credits is something that you're always going to have to use in accounting. That's going to come into play the rest of the semester as we dig deeper into the different classes of assets, liabilities, and equity. Now, we've kind of went through and we've looked at the whole big picture, kind of how to identify, record, and then communicate that information. Now we're going to look at a lot of the measurement and recording, okay, of the different asset classes. We're going to talk about specifically with the cash, will be chapter 4. Chapter 5, I believe, is receivables. And then in chapter 7, we'll do inventory. Okay, and that'll be it for this unit, 4, 5, and 6. Yeah. Cash, receivables, inventory. And then you do long-term assets and current liabilities in chapter 7 and 8, and then long-term liabilities and stockholders' equity in 9 and 10. So we're now running through the balance sheet here. Now we're going to look at each individual account there and how that account relates to the balance sheet, how it relates to net income, how we make the journal entries in order to make that possible. Okay, so hopefully you are understanding your debits and credits pretty well. If not, please reach out to me and maybe we can set up a time for a Zoom meeting, one-on-one type of thing, and we can help you get through this. All right, so, but before we get into a bunch of deep debits and credit, chapter 4 does start off talking about kind of shifting gears here and talking about some other non-computing stuff, what I'm looking for here. Let me share my screen. We're going to start off, we're going to talk about internal controls. All right, so we're going to talk about internal controls. We're going to start off chapter 4. Okay, internal controls are procedures and policies that are put in place in order to ensure the integrity of the accounting system. While this came about with the Sarbanes-Oxley Act of 2002, it is the most influential piece of legislation to affect the business world. And probably almost 20 years ago, so 20 to 50 years ago. You can go back a little bit. And it really started to hold businesses more accountable for their financial reporting information. There was a lot of fraud and stuff. I get into this in more detail in my longer classes. And we go through some examples, but this is like when Enron happened and I think Xerox was around this time and WorldCom, a communications company. And there was just a lot of accounting fraud going on, basically. And the people at the top, the head of the corporations, obviously they probably knew about it, but they were able to shuck it all off onto the accountants and say, well, we really didn't know about it. So this started holding people a lot more accountable for their actions. 2 major sections we're going to worry about in this class. There are 11 major sections to the Sarbanes-Oxley Act. We did a lot of stuff. We're going to worry about section 404, where it requires management to produce an internal control report. So management is responsible for implementing internal controls now. So they are supposed to be checking over the reporting numbers and finding any errors and correcting them. And management is held directly responsible, puts more of an emphasis on them. And then 302 requires that the principal executive, so that's the chief executive officer and the chief financial officer, the CEO and the CFO, they must personally sign off that they have established and are maintaining these systems. It's a little more personal accountability coming now. So hopefully internal controls get a little bit tighter. Also part of that Sarbanes-Oxley, that coming from that came the Committee of Sponsoring Organizations of the Treadway Commission. Okay, we kind of want to call it COSO for short. It's a bunch of business leaders, accounting leaders from around the world, not just the United States. They got together and they said, well, what, if we're gonna make everybody have internal controls, we kind of need to define what internal controls are. And this is what they came up with. So if you're taking notes on this, these are their 5 activities here. Leave a little space in there because we're going to talk about each of them individually here and we go through the slides. Okay, so first is the control environment. Okay, that's just basically the kind of attitude. It's quoted as the tone at the top. Okay, it's how what you see your superiors do. Is it rubbing down on you? Okay, if you want to have an ethical environment, but you see that your boss is operating in an unethical way, it's not going to lead you to want to behave in the most ethical way either when you see people getting away with it. Okay. So it's kind of philosophy, the policies, practices that the business has put in place, overall integrity. Okay. Second is risk assessment. 2 types of risk: strategic risk and business process risk. Okay, strategic risk are the ones that you're facing from the outside. You're always going to have your competitors. They're coming at you. Okay, that's a strategic risk. Sometimes you need to maybe increase your prices, decrease your prices, something like that, in order to stay competitive. Business process risk. That's stuff that's from inside, where processes may become outdated, no refusal to change. You're not allocating your resources correctly to meet the change. I think like Blockbuster Video, their business process risk with how they refuse to change. They had a lot of strategic risks because they had a lot of companies popping up around them. There was Netflix. Netflix kind of went out on that, but there was other streaming markets and stuff like that. When Blockbuster Video used to hold a big, the movie industry was beholden to Blockbuster because of their rental power, but their business process risk was what they succumbed to because they just refused to change and adapt and held on to their brick and mortar stores too long. All right, which of the following can most likely be prevented through the development of a good internal control system over financial reporting? But it's just incompatible work duties. Mistakes in judgment are going to happen. Employee fatigue, basically employee error. Collusion is always going to be hard to detect because when you get 2, 3, 4 people working along the same lines, it does become more difficult, but internal controls are supposed to help with that. But really, incompatible work duties are be the major problem. Okay, so after you have the tone at the top set, you've assessed your risk. The major thing we want to worry about here are our control activities. This is kind of the heart of the chapter here. Control activities is what policies and procedures that are put in place, the specifics of them that directly ensure that the objectives get met. Okay, so first we have a clearly defined authority and responsibility. Who is performing these duties and assigned tasks? Okay, so say you work at a bank. Each teller who's working the drive-through window, who's working on the inside line and stuff like that. They're all going to be assigned to that workstation. Okay, that cash that they have in there that they're handling, that is going to be their responsibility. Okay, we're looking at internal controls, and most importantly, we're trying to internally control our cash, our local assets, and our inventory and stuff like that. So when you have clearly defined authority and responsibility, each one of those people working inside that building that are behind one of those cash registers, they have that clearly defined authority and responsibility of being there, and that money that they have allocated to them is their responsibility. Segregation of duties. This is kind of along the same line. Once you have clearly defined authority and responsibility, okay, so I'm working at the bank, I'm in charge of this here, money. Now it's the end of the day. I'm just gonna go put it in the safe, say I have however much money I say is in there. Nobody's going to check me, okay? That might be a clearly defined authority and responsibility, but we need to segregate some duties in there. There needs to be a management person behind me taking that from me to accounting and making sure what I say is in that drawer is actually in that money drawer. Okay, and then once they get it, that person takes everybody's money drawer and puts it in there, counts it all up, and put it in the safe. You don't want somebody else to come and take that money to the bank. Okay, we're segregating our duties there. So that way, every step along the way, from the time it comes out of the money till in front of the cashier, from the time management touches it to the time it gets into the bank, there's always kind of a segregation of duties in there to ensure that nobody's slipping anything out at any point in time. Third is adequate documents and records. Always want to use source documents. So here we're going to be talking about invoices. Okay, so when you're making purchases, you want to always make sure you get the right invoices when you're sending out receivables. Okay, for people that have made sales, you want to make sure you adequately document and record this. Okay, so when we get to talking about current liabilities and receivables, we'll really be talking about documentations and records. As far as cash goes, it's also, you'd have your cash slip from each of your workstations, you know, and the manager will get them all together, have a total, fill out that deposit slip, fill it out in 3 different formats, you know, one for them, one for the bank, and one extra just in case. And then safeguards over assets and records, that is the 4th control activity. So that is physical safeguard you want to think about there. And also electronic, web-based. Okay, so you're thinking about because everything's stored in computers nowadays, so now you're thinking about the security system that goes around to, you know, keep your computer information safe from even physical safes and physical cages to lock up inventory and stuff like that. Those would be safeguards over assets. And then check on record amounts requires independent verification. So that is your auditors. Well, if anybody here wants to go into public accounting, there's a chance you might be an auditor one day. You'll be going out and you will be doing the checks on the recorded, checking on the recorded amounts. Which one of this is segregation of duties? Let's say, A, cashier does not have access to accounting records. Okay, so you're gonna need to be able to identify each one of those as they are. Information and communication. All you really need to know here is that information needs to be timely. Okay, in order for it to be useful, it has to be able to get there in a timely manner, has to be communicated efficiently. And then monitoring. Again, it goes back to that, the check is your check on your controls, monitoring. The Sarbanes-Oxley Act actually made it had a lot to do with the auditing of companies. So the monitoring is very, very heavy on publicly traded companies now. They're constantly getting audited and have their books examined, so it's important that you want to work in accounting, understand the GAAP rules in order to play by them. Okay? The accounting system and the internal controls, I mean, they fit together. You have to understand internal controls to understand why accountants do what they do. Because everybody's always looking over their shoulders, they want to make sure, double check this, double check that. Are you sure my money's going here? You have a lot of eyeballs looking in, so there's a lot of internal control processes going on. Why it's important to understand actually what the accounts are doing. So if there is something kind of funny going on, you have an idea of what it actually should look like. So if you're not going to be an accountant, it's a good reason to learn accounting. Right, so now cash specifically, we're going to get into. Cash includes, when we're listing cash on our balance sheet, cash is going to be everything that is cash or a cash equivalent. Cash equivalent is anything that can be converted to cash within 3 months. So if you had bought some stock out on the stock market as a business and you plan on turning around and quit selling it off, it's called a short-term investment. That would actually be considered a cash equivalent. So it will be listed as cash on your balance sheet. Okay. It's reported on both the balance sheet and the state of the cash flows, which we're not going to talk about. And on this class, that is an accounting 2 class. Okay. Right. So there's just an example of what a balance sheet will look like, cash and cash equivalents. It'll give you an idea what they are. The 3 things we are going to do is where you're going to get your calculation problems out of this chapter are some internal controls over the cash account. One is a bank reconciliation. So I don't know if anybody's ever done one of these before, because everything's so digital now that if you're out using your own personal debit card, you can kind of look online and see where you're at. You don't have to worry about that bank statement coming in the mail. Okay. Companies still use a lot of checks. Okay, electronic fund transfers. So a bank reconciliation is very important for businesses to make sure that their cash account is listed properly at its proper amount, because you're going to see a lot of times the bank and the business, they're never going to have the same amount. So there's always going to be something wrong. Not really wrong, it's just unknown. And we'll see that cash over and short monitoring, okay, for businesses that have retail environment where they're collecting cash. If you ever worked at a gas station, worked in fast food, anywhere you've had to handle money, I'm sure your drawer was 100% accurate all the time. Yeah. I believe that when I see it, because I worked in that industry for many years, and cash drawers are never correct. Over and shorts happen all the time. And then there's a thing called petty cash, which a lot of small businesses have, where they'll set a small amount of cash aside in their safe or somewhere within their store to pay for minor emergencies that arise that don't need, so they don't have to go through and get corporate authorization. Okay. So first, here's a bank reconciliation. One, what we're trying to do here is the bank is going to have a balance. They're going to say, you have this much in your account. And you're going to go to your books, your journal entries, and your ledger, and you're going to look at your cash account, and it's going to say, well, we should have this much cash in there. Okay. Those 2 numbers are not going to balance. Okay. There's 3 different reasons for that. There's some stuff that has been recorded by the business that has not got to the bank yet. Okay. There's some stuff that the bank has done, and some internal charges, this is number 2, that we do not know about as a business. Okay, until we get that bank statement. And we need to make some adjustments. And 3, there are errors in reporting adjustments. Okay, So transactions recorded by the business, but not yet recorded by the bank. And first are outstanding checks. So say businesses write a lot of checks, might not be an electronic fund transfer. So when a business writes a check, they're going to record it and they're going to record it as soon as the day they send it out to pay for that accounts payable. Okay, it's got to get to that business, they got to put it in their bank account, it's got to go through the Federal Reserve, get back to the original bank account. Okay, could be 6 or 7 days sometimes before a check goes through. An email check before it actually comes out of the account. So if you had a closing of reporting period or in between when the bank statement came out and you looked at your cash on that day, there may be some checks that you've recorded on your books as being taken out, just has not gotten to the bank yet. So we're going to make an adjustment. Second is a deposit in transit. It's kind of the same thing. If you're working and you have a company, it's a safe company, you know, they come by with their safe truck and they pick up your cash and take it to the bank if you're working in a bigger city. Maybe that has not yet got to the bank to be recorded. It's called a deposit in transit. It is a deposit that we've already recorded on our books, but yet the bank has not processed it through on their end. Okay, stuff that the bank might know about, but we do not know about yet, so it also needs an adjustment. First are non-sufficient funds checks. Okay, that's when somebody writes you a check as a business and you put it in, you made a sale, you accepted a check, you go put it in your bank account, and it comes back from the bank saying this person did not have any money in this account. Okay, that is a non-sufficient fund check. Okay, so you have it counted as being cash on your end, but the bank say, oh, you can count that as cash, you didn't go through. Okay, and then they have debit memos and credit memos. This gets a little confusing for some students because we have to look at this from the bank's point of view here. Okay. A debit memo to our account for everything that we've been talking about so far, a debit increases cash. I don't want you to forget that because a debit does increase the business's cash. But when you get a debit memo from the bank, it means they are taking your money out of your account. And so your cash is going down. The reason is because the bank's cash is going up. If you look at it from the bank's point of view, the bank sends you a debit memo and says we're taking your money because our money's going up. Okay, so a debit memo means that you're taking money out of our bank account, usually for like a prepaid payment, electronic funds transfer. Okay, or maybe there's some kind of service fee on the account that they go through. Credit memo means they're putting money back into our account. And maybe that is because they are collecting a payment from us. Maybe people are paying directly to the bank. We made an arrangement. When we make the sale, they pay directly to the bank in the form of a bill payable, and the bank collects it. Okay. But when we do a bank reconciliation, we're going to go through, we're going to make sure that all these things, we account for them all, kind of move them around, put them where we need to put them, and make sure that we come out balanced, because we really want to stay balanced as accounts. And then finally, there's errors. Biggest errors, transposing numbers. I do it myself sometimes. You know, flipping numbers around, instead of 721, I put 712. Okay. So you always need to just match stuff up. So we perform a bank reconciliation. Like I said, we're going to have two different kind of headings here. We're going to have a balance per bank and a balance per book. Okay. And they're going to be different amounts. And we're going to go through and we have to analyze our accounts. Okay. First, compare the canceled checks that are electronically returned with the bank statements, the amounts credited on the cash account. Okay. So for step 2 here, Trying to pull this up, this is the slide handout one. You know, you have that on your screen there. So this step two is compare the cancel checks and electronically return with the bank statement. So if you have slide handout one, so it look like, so you have a bank statement here. You have a balance up here that has them at 4,000. Something's too far away from me to see. But list all the checks here. And here's what our company records indicate. It indicates only cash down here of around a little under $4,000. Okay, and this says this is all the checks we've written. These are the checks and deposits that the bank knows about. Okay, and you see this all the information here, and we have to identify what is wrong. Okay, what have we done that the bank doesn't know about? What has the bank done that we don't know about? All right, so if you kind of looking through that, because this here says refer to that bank statement that I just showed you, recognize that the beginning balance, kind of go through and see if you can figure out what was wrong. All right, so this is what you should have found. 4 items in the cash account do not appear on the bank statement. August 31st deposit and checks, okay? So the deposit is a deposit in transit. Okay, you notice that you're looking through there. The company has recorded it on their books as being in their cash account, but the bank has not yet received that. Okay. Checks 1901, 1904, 1905 are outstanding, meaning we have taken them off our books, but the bank has not. The bank still has that in their account. Okay, and then there's also an error. Before we get to the error, let's look here. So our bank said we had $4,165.04. We need to add in the deposit in transit to the bank statement to make it accurate. Because they have not recorded it yet, but it is going to be there. Okay, so to make it the most accurate, we add the deposit in transit. But also, when these checks go through, our cash account's going to go down from the bank. So we need to subtract them out. And if we've done this, we get an adjusted balance of $3,408. All right, so that's how you would adjust the bank. So we have an error here where it is 78, not 87. So if we recorded it as 87, and it should be recorded as 78. Okay, that was a check that we had written out and paid out. We actually were off by $9. We made a $9 mistake when we reported that in our journal. We need to add that $9 back into our cash account. They collected some interest for us, so we would add that in. But we had a service charge for having the account of $14, a non-sufficient check. So cash we thought we had, we do no longer have, so you have to subtract that out. And then they gave us a debit envelope for the electronic withdrawal of the electric bill. And once we make those adjustments to this balance, we get $3,454. And we see that we are balanced, and that is actually the correct amount of cash that we would have available at this point in time. Right. What is the adjusted company balance on the bank reconciliation? So the company record says we have 5,575 outstanding checks. Do we need to worry about it? Not on the company records because they've already recorded it. Deposit in transit, do we need to worry about it? Not on the company record. That would be an adjustment to the bank records because the bank would not know about it. Service charges, yeah, we'd have to take those off. So that takes us to our 55.75. We take the 75 off, it's 55.50. Interest revenue, yeah, we wouldn't know about that, so it'd be 55.25. And that is your answer. Okay, first two here, we would only need to make adjustments to the bank records if we had access to them. Kind of in line with that question, we're gonna have to make journal entries to make our cash account correct. Okay, no adjustments are needed for outstanding checks or deposit in transit because, like I said, we've already recorded that. The adjustment just needs to be made to the bank account side to make sure they're right, and we'll make that adjustment on their end when they actually get the stuff. But we do need to make adjustments for any errors or charges or interest that's come from the bank, okay, that was not previously recorded. We do need to get them into our accounting system. So after we did that here, our cash would have increased by 9. When we paid that bill, we made it an accounts payable. Okay, we took it out of accounts payable, but we need to put it back into accounts payable. Okay, because we took out an account that we actually didn't have. Okay, here we got cash for interest income, interest payment, it's a revenue. Here the bank charges the service charge, it's an expense, so we debit it, cash went down. Accounts receivable, because somebody paid us for a note on an account, they owed us, so. Oh. No, this is the non-sufficient fund check. Okay, we took it out of our receivables and counted it as cash when they paid us. But now that the check has come back, we debit our accounts receivable to make it go back in there and credit our cash. And finally, another expense, lowering our cash. All right, cash over short. Okay. This is a significant expense. Okay, usually if you're going to run a business, have a limit for your cashiers on what you want them to be, usually $2, $5, somewhere there, however you want to be. Don't expect your cashiers to be perfect, but you can't give them too much leeway. Cash over short is a big thing. Okay. Here it's saying that the deposit should have been 20,671, but it was 20,685. We'll let you look through here. Here they had cash. You had to calculate the sales revenue because of what was given, but you see that it doesn't match. However much cash the tax, this is how much cash we should have from both our sales and what we collected from receivables from the information given. This was the actual cash. It was $14.02 short. So this is an adjusting entry or an additional kind of entry that needs to be made into a journal entry when recording cash for the day, cash sales for the day. A lot of times, okay. You may not have the receivable, which has the sales revenue. You know what it should be. You know how much cash you do have, and you know how much over short you are. If you make a debit, it's because you're short. If you make a credit, it is because you're over. And finally, petty cash. Petty cash is just a small amount of cash kept in a lockbox, usually $500,000 in case of an emergency. Okay, if people take the cash out as needed, and they put the receipt in there, and it's commonly filled every so often, say monthly. Okay, what's important to know here, one, when we establish the petty cash fund, on the very first day that you make it, you debit your petty cash, you credit cash. Okay? Whenever you replenish it, you're not actually affecting the petty cash account anymore. Okay, you look at the receipts. Okay, $175 went to buy supplies, $70 was for postage, $25 for delivery, and $93 in miscellaneous expenses. We record them right now as we put 363 cash out. Okay, and basically it's kind of keeping that petty cash balance at 500. Okay, that's what that cash is doing there. Only time you make an adjustment to petty cash is if you change how much is in there. Like if you had 500 in there and you wanted to make 1,000, then you would do petty cash for 500. Here they are adding another $100 to the petty cash. Just putting it up $100 more. So I said that's the only time, or if they were closing it out, that is it. Read the rest of this. I'm just going to let you read through it on your own. I've bored you long enough now. If you look on chapter 4, I'll have some old videos up also.